The economy is not doing so hot right now. Do you want to know why? This video will take you through the basics of economic crashes and downturns. First, let's start with a look back at some of the biggest stock market crashes in history. Is the stock market going to crash? I have no idea, but it has definitely happened before. Let's take a look at the biggest crashes in US stock market history, and make sure you watch until the end to learn about the time the stock market crashed nearly 90%. Let's start with Black Monday in 1987. On October 19th, the Dow Jones Industrial Average plunged 22% in a single day. This is the biggest single-day decline in history. By the start of November, nearly every index in the market was down more than 20%. No one was safe. But what caused this? Well, nothing in particular. Rather, it was a series of events like a growing US trade deficit, the growth of algorithm-based computer trading, and growing tensions in the Middle East. The significant, rapid drop on Black Monday was likely due to computer algorithms deciding to pile on to the sell-off, crashing the market even further, though. Next, let's talk about the dot-com bubble of 1999 and 2000. The Nasdaq Composite, the index that tracks tech companies, had surged nearly 400% since 1995. It peaked at 5,048 points on March 10, 2001. By October, the index was down nearly 77%. This crash wasn't as quick as Black Monday, but it was just as significant. The popping of the dot-com bubble refers to the overvaluing of internet and technology stocks that occurred in the years prior, as investors came to terms with the realities that these companies might not be all they're cracked up to be. Their values plummeted. It took the Nasdaq 15 years to reach the peak it had hit in March 2001 again. The financial crisis of 2008 was also pretty sizable. This crash was due to increasingly liberal lending guidelines, increasing the number of subprime loans that made up the mortgage market, held in securities known as mortgage-backed securities. If that sounded like word soup, I have a video explaining the 2008 financial crisis for dummies linked right here. Essentially, home debt ballooned, people couldn't pay their mortgage, and the entire mortgage market collapsed. In March 2007, Bear Stearns, an investment bank, went bankrupt. This was a warning sign, but the market kept growing, hitting a peak in October of 2007. By September 2008, though, the market was down more than 20%. By March 6, 2009, the market was down a total of 54%. The 2008 crisis was essentially the slow collapse of the entire US financial system. It took 4 years for the Dow to rebuild from the crash. This next crash is one that you might remember, the coronavirus crash of 2020. During February 2020, the market crumbled 12%. On March 12th, the Dow tumbled 9.99%, the single biggest drop since Black Monday in 1987. On March 16th, it tumbled another 12.9%, beating the record set just 4 days earlier. But what makes the coronavirus crash unique is that the market recovered nearly instantaneously. It was already back up to its previous peak by May of 2020. But why did this happen? Well, basically because the Federal Reserve essentially decided to print money endlessly, propping up the US economy alongside Congress's stimulus packages. If you want to learn about the Federal Reserve and what they do, you can watch my video on the topic here. Finally, let's talk about the stock market crash of 1929. It's the worst crash in stock market history, and it kickstarted the Great Depression. In 1921, the Dow rose from 63 points to 381 points by 1929, basically 600% in less than a decade. On September 3rd, 1929, it started dropping. On October 28th and 29th, the market crumbled 12% and 13% each day, respectively. By November, the Dow was down more than 50%. This continued until the summer of 1932, when the market was down to just 41 points, 89% off its high set in 1929. It would take until 1954 for the market to regain its value. The crash of 1929 was due to excessive leverage. Many investors in businesses were using debt to buy stocks, meaning that the market was propped up by cheap debt. But when the market started going down, no one could pay off that debt, and thus the market crashed. Now that we see just how bad some crashes in the past have been, let's talk about what caused many of these crashes: stock market bubbles. A stock bubble is not a giant floating bubble that holds stocks of companies inside of it. At least, literally. Stock or asset bubbles are characterized by economic cycles that have rapid increases in underlying value far beyond an asset's intrinsic value. Bubbles are usually only defined after the fact, once they pop and the value of a stock or group of stocks tanks. Stock bubbles are figuratively a grouping of stocks that float higher and higher, like a bubble, seemingly for no reason. They eventually have nowhere to go but to simply pop and plummet back down to reality. So what really are bubbles and why do they happen? Bubbles can happen for a number of reasons, and they generally occur due to changes in investor behavior. Investors may decide that, say, the technology sector is where the most growth potential is, pour all of their money into that sector regardless of whether a company is good or not, pumping up the values of every single tech company. Eventually, though, only the good companies survive, and even the profitable ones may not deliver on all of their promises. When this reality sinks in, investors sell their bad stock, take their profits, and they usually do this rapidly, causing the bubble to pop. Strictly speaking, bubbles are economic cycles characterized by slow to rapid valuation growth, followed by rapid devaluation at an unknown time. Bubbles follow the trend of displacement, boom, euphoria, profit-taking, and panic. Displacement begins a bubble cycle when investors notice a new technology, something new to the market, or they can access easy money to invest cheaply. Then there's the investing boom, either in a whole market, one stock, a grouping of stocks, or any other asset. Once they boom, investors are euphoric about the valuations and all of the money that they made. Once everyone realizes they've made a ton of money, though, they take their profits. It starts slow, but in a bubble, it quickly accelerates, rapidly bursting the bubble. The people who waited too long to sell can lose everything in a flash. Don't get caught by a bubble popping. After bubbles pop, everyone panics because they don't know what's a good investment or not. Eventually, though, markets will stabilize and steady growth will continue. Investors can make a ton of money on bubbles, but they can also lose everything. Some of the best examples of bubbles are the dot-com bubble in the 90s and the housing bubble in the late 2000s. The dot-com bubble inflated the price of any stock related to the internet. Investors thought the internet was the next big thing. It was, and they gave any company venturing into this new frontier tons of cash, more than it was worth. Eventually, companies failed and investors questioned exactly what the internet would mean for businesses. The stock market dropped by roughly 10% overall, but some companies dropped billions in value. But hold on, what even is a bear market, or markets that consistently lose money? A bear market is one where different types of bears trade stocks. Stocks that do their best in bear markets, understandably, are those like BBW, or Build-A-Bear Workshop, or PG, Procter & Gamble, because the bears love the Charmin bear, owned by Procter & Gamble. What? Sorry, that was the wrong script. 1 second. A bear market is when a market undergoes significant and prolonged price declines, typically over 20% in a given period. Bear markets are also characterized by overly negative market sentiment and pessimism. In general, bear markets occur in stock markets about every 3 to 4 years and generally last about 289 days. That's to say, bear markets aren't uncommon. Rather, they're a facet of regular market cycles, generally. There are also occasions where bear markets are triggered by significant external factors that cause markets to plunge. Let's take a closer look at how bear markets work, what factors affect them, and take a look at some of the largest stock crashes in history. Stocks are generally traded at prices that reflect future expectations of earnings and profits. This means that in some senses, stock prices are propped up by optimism for the future. When optimism about the growth of a company or even an entire industry shifts, then stocks begin trading on fear. This shift from optimism to pessimism usually marks the beginning of a bear market. A bear market is a fairly vague term, but economists usually try to quantify it by putting 20% as the decline needed to trigger an official bear market, or being called an official bear market. Many a bear market has been triggered by slowing economies, bursting bubbles, geopolitical challenges, wars, and more. All factors that affect how people feel about money and the future of doing business. While the average bear market lasts under a year, there's really no set time that can define it. Some bear markets can last decades. In these markets, there will still be rises in stock over a shorter given time period, but the overall trend of the market will remain negative. And this brings up a good point. Investors can still make money in bear markets by being pickier about which stocks they choose to invest in. Bear markets refer to the overall trend of a market being negative, but there will still be blips of positivity in there alongside certain strong performing stocks. Bear markets are going to have 4 set phases, and you should be familiar with them. Number 1 is the optimism that transforms into pessimism phase. This is where investors start to feel more and more negative about the future of markets. Number 2, there's usually a sudden stock drop. As pessimism and fear take over, investors will generally function in a herd mentality, triggering a quick and large sell-off to gap downwards. 3, the period of speculation. This is when stocks have dropped enough, speculators and traders hoping to cash in swoop in and drive up prices of select stocks, increasing volatility in the markets. 4, the final phase is the slow fade. The final segment is when the rate of sell-off slows, eventually declining to flat, and this is when a bottom is put into the market, and after this point, stocks begin trading upwards as a trend, establishing the beginning of the next bull market. One important thing to note about bear markets is that they're not the same as corrections. Corrections are short-term trends over a few months, often referred to as cooling off from an overheated bull market run. Corrections occur during bull markets. Bear markets, on the other hand, are completely the opposite of a bull market, and they're longer-term events and trends that take time to be established. Now, as we're currently living through the crash of 2023, the Federal Reserve sure is printing a lot of money to try to save the economy. But why are they doing that? It keeps in line with a concept known as modern monetary theory. Let's talk about that. Can the government just print endless money with no consequences? Well, maybe. The idea that money has to be tied back in physical goods like gold or silver is a fading ideology, and our modern system of fiat currency ties the value of money to consumer confidence in the government that backs it. Even with that said, printing endless money sounds like a bad thing, no? Well, possibly. It could lead to massive economic collapse and the devaluing of everyone's money. However, some economists think that if done right, governments can just keep printing money with few repercussions. That theory is well summarized in something known as modern monetary theory, or MMT. Modern monetary theory states that countries that are monetarily independent, like the US, UK, Canada, and Japan, are not constrained by the amount of money they can bring in from taxes or revenues in determining their budgets. In other words, countries that don't rely heavily on other currencies don't have to worry about balancing their budgets. If the US brings in $10 in taxes, they could theoretically spend $12, $15, $20 without issue. But this is oversimplified. Why would economists think that this could work? After all, isn't a balanced budget good and debt bad? In microeconomic situations like a household, this is certainly true, but macroeconomics for countries works differently. Under the guidelines of MMT, governments wouldn't need to rely on taxes or borrowing money from bond sales, selling their debt to consumers, because they issue the money in the first place, and no one else can print the money other than that country. This is a really challenging idea, especially when contrasted with the typical idea that debts are bad and a balanced budget is the only way to succeed financially. In many senses, the ideas of MMT flip on their head traditional economic beliefs about how a government interacts and controls its own economy. If the principles of MMT work, it could be used to fund massive healthcare reform, debt reform, and otherwise reset many failing economic systems, particularly in the US. One of the core principles of MMT states that in countries that have a fiat currency system that they fully control, like the US, Canada, and other countries, they can simply print as much money as they need, as the government really can't go broke because it makes its own money. Detractors to MMT say this would be irresponsible, as it would massively devalue the currency, inflation, causing the country to be in massive amounts of debt with a valueless currency. But here's what makes MMT work, theoretically. It's the idea that government debt isn't a key factor in the economy like many think it is. Global, economically important countries like Japan and the US and others can carry a much greater budget deficit without worry, according to MMT, and small deficits can actually cause recessions. Since debt spending or deficit spending is what grows wages and savings, if a country runs a small deficit, savings and wages would actually fall. Theoretically, that is. Macroeconomics is complicated, like we said. According to the principles of MMT, government debt is just the government putting money into the economy, stimulating it for growth. MMT supporters don't have their head in the sand, though. They recognize that inflation could be a major negative side effect to this type of spending. However, inflation can actually be fought with political policy by adjusting interest rates and other macroeconomic cogs. It's in this way that one can't view government debt in the same way that you view household debt, because the government has some control over its lenders, as it makes the currency itself. An oversimplified analogy would be like a homeowner having the ability to hurt their mortgage company's profits unless the mortgage company gave them better terms on their mortgage. But if the government can print endless money, why are taxes needed then? Well, under MMT, taxes are used to take money out of the economy to control inflation and make sure the economy doesn't burn out and eventually crash. Traditional instruments like bonds and taxes that are generally viewed as revenue generators for the government, under MMT would simply be ways for the government to drain excess cash from the economy as a way to control the currency's value. According to MMT economists, the unemployment rate is a direct result of the government spending too little after collecting taxes. If you're unable to find a job in the private sector, some MMT policies would allow for termed government or local community employment to control inflation. This idea also insists that rather than just paying welfare to people who sit at home and never plan to find a job, the government could employ them, cleaning up the community and serving the government's citizens while they looked for private sector work. But why do economists think MMT would work? Did they just pull this out of thin air? Well, it all started with the American economist Warren Mosler. Mosler first theorized the concepts of MMT in the 1970s while working as a trader on Wall Street. In the 1990s, many investors were worried that the country of Italy would be unable to pay back their loans. Mosler, now having solidified many of his theories, knew that this was impossible, since Italy created their own currency, and his firm thus became one of the largest holders of Italian currency. Italy consequentially didn't default, and Mosler made about $100 million. But the theories of MMT from Mosler were mostly ignored by economists over time, largely due to how subversive they were to traditional macroeconomic theory. Thanks to the internet, though, MMT has become more of a popular economic outlook. MMT is also supported by many more progressive political leaders in the US, perhaps to its own demise. Alexandria Ocasio-Cortez and Bernie Sanders both hold on to MMT as a potential future path for the US economy. But for the most part, we've made modern monetary theory sound pretty rosy in this video. So what are some drawbacks? Detractors state that MMT can simply be used for countries already in economically depressed times. It cannot do well in a thriving economy. MMT would essentially cause a country to only care about its own economy or currency. It doesn't leave much room or provide much guidance for how international politics would thus impact the economy. If the US adopted MMT and over time the international community stopped relying on the US as much and thus didn't want dollars as payment, the US dollar could trend towards worthless. Like mentioned before, since the US dollar is a fiat currency, like most world currencies today, its value depends on consumer sentiment in the government that creates it. Nobel Prize-winning economist Paul Krugman is one of the major detractors to MMT, stating that driving up government debt like MMT supposes would almost certainly lead to hyperinflation and devalue the currency. The 2023 crash has largely been started by the collapse of many banks, but why did these banks crash so suddenly? To a significant extent, it has to do with a concept known as fractional reserve banking. What if I told you that the entire modern financial system functioned on an infinite money glitch where billions, no trillions of dollars were created out of thin air day after day, and at any point the whole system could collapse? Oh, you wouldn't be surprised? Oh, then I guess let's just end the video here. Wait. But what I just said was the truth, and it's something called fractional reserve banking, otherwise known as the infinite money glitch. Here's how it works. When someone deposits $1,000 in the bank does not hold on to all of that money. Rather, the bank will just keep 10%, $100 as reserves, and then loan out the rest, or $900 to other people or companies, charging interest on the loan, making additional money for the bank. The lendee, or the person that took out the $900 loan, then goes on to spend that money. To simplify the scenario, we'll say that that person with a $900 loan immediately paid someone else that $900. At this point, when looking at this small financial system, there's a total of $1,900 in circulation, but the bank only has $100 in reserves. But here's where the endless money glitch occurs. The person that was paid the $900 then goes to deposit the $900 in the bank again, starting the process all over. The bank would keep 10% or $90 and then loan out the remaining $810. Then the person with the $810 loan would pay someone else, who then deposits that money in the bank, and the bank then keeps another 10%, loans out the rest, and the cycle continues. This cycle of monetary multiplication is called the monetary multiplier effect, or the infinite money glitch. In this example, $1,000 in initial capital can be transformed into $10,000 in the economy, all from nothing. $9,000 created out of thin air. Add a few zeros to those numbers and you can start to understand how much money in an economy can simply be created through fractional reserve banking. This infinite money glitch occurs because banks only have to retain a certain percentage of deposit due to liquidity requirements. The rest of the money they can go out and make money with through lending. In practice, the system of fractional reserves can create an infinite money glitch if lending and borrowing becomes irresponsible and pervasive enough throughout the society. The infinite money glitch is also metaphorically the stacking of financial dominoes. If all of the depositors were to want their money back at one time, called a run, the bank wouldn't have the funds to pay everyone back. This is why government-backed insurance, like FDIC, is a necessary protection on bank deposits. In simple terms, this is how the fractional reserve banking system works, and it's the system in place by most modern economies, including the US. The exact cash-on-hand requirements for banks in the US is set by the Federal Reserve, the central bank, which will often put banks through stress tests, simulating potential bank run scenarios or financial collapse scenarios to ensure that a banking crisis doesn't occur. This level of safety is usually enough to ensure the infinite money glitch in modern banking doesn't unravel the whole system. Usually. China is currently seeing their fractional reserve banking system fall apart as real estate loans made on fraudulent real estate are crumbling. The fractional reserve banking system is susceptible to financial fraud or misrepresentation of loans, and if the bank lends out this infinite money thinking it's all going to trustworthy borrowers, then it assumes it will get most of it back. However, if all of the trustworthy buyers end up having to declare bankruptcy, then the bank is just out of luck and on the hook. This is what the stress test the Federal Reserve puts US banks through tests. The central bank has default rate numbers that it simulates banks' abilities to remain liquid through. However, when anomalous and unexpected default rates occur, usually due to fraud, the system can collapse. All of this, of course, is oversimplified, but it speaks to underscore the fundamental principle to modern banking, fractional reserve banking, and the infinite money glitch that it creates. While we've given a brief overview of past crashes, let's dig deeper into one of the biggest crashes in recent history, the 2008 financial crisis. This next section will take you through the basics of something known as mortgage-backed securities, the cause of the 2008 financial crash, and other things known as credit default swaps. If you've seen the movie The Big Short, get ready for it to make a lot more sense. If you've lived through the 2008 and 2009 financial crisis, or if you've been paying attention to the news recently, you've likely heard the term mortgage-backed security. You likely know that it's loosely related to mortgages, but also isn't directly a mortgage. The rest tends to get a little complicated in financial jargon. Mortgage-backed securities, or MBS, and the market that surrounds them are a major underpinning of the US and world economy. So it's important to understand them if you want to understand greater economic actions. Let's explain this market simply in common terms so everyone can understand. Ever since mortgage-backed securities were invented in 1981, they have become a larger and larger asset class around the world. Explained simply, MBSs are simply shares of mortgages that give you returns based on the payments people make to those mortgages. These securities are basically a bunch of mortgages, say 1,000, lumped together into a shell sort of corporation. Investors can buy stock in this company and make returns on their investment based on how well people who have the mortgages, the home buyers, make their payments and otherwise honor their loan. So here's how it technically works. You, the loan seeker, go to your neighborhood bank wanting a mortgage for $100,000 over 30 years at a 5% interest rate. You have a good job and a good credit score, and the neighborhood bank takes all your financial metrics about you, how much you make, your credit score, how much you put down on the house, etc., and cross-references them to guidelines set out by larger investment banks like Fannie Mae and Freddie Mac. If you meet the guidelines that are laid out there, you're approved for the loan and it's considered a conforming loan. In other words, your loan conforms to the guidelines. There are ways to get non-conforming loans, but you'll end up taking out a higher interest rate or having to put more money down so investors know your mortgage is a safer bet. We'll glance over this subject for now for simplicity's sake. Once your neighborhood bank approves you for the loan, you can buy a house. Your neighborhood bank gives the seller the $100,000 and you are indebted to them for 30 years at a 5% interest rate. Once the transaction is done, however, something interesting happens. Your neighborhood bank doesn't want to wait 30 years to get their $100,000 back. After all, they may not have a ton of money to invest in things, and they may want more of their money back to invest in better investments. Because of this, the neighborhood bank will look to sell the loan to a larger bank. Larger investment banks will do this because your loan represents a safe investment and a good value. So bank number 2, the investment bank, will pay the neighborhood bank the $100,000 for the loan, and now you, the borrower, will start paying your loan back to bank 2. But why would the neighborhood bank want to do this? How would they make money? The short answer is fees. Mortgages will have closing fees attached to them. These fees are how neighborhood banks make money. The originating bank never has any intention of holding the loan and getting your payments. In fact, this is why mortgage-backed securities were invented. The neighborhood bank can supply endless mortgages with their small amount of cash and never have to worry about taking in more deposits. It gives them an avenue to stay profitable. So, now the neighborhood bank has made its money. Let's move on to figure out how the larger investment bank makes its money. Bank number 2 didn't just buy your loan, it probably bought thousands of others, or in this case, 999 other loans. Let's say for all the same price, and they all have the same interest rate and term. This won't be the case in actuality, but for this demonstration, it'll make the most sense. So now, bank number 2 has 1,000 loans for $100,000 each that will give them 5% interest each year. In other words, they have $100 million of loans that will pay back 5% in interest each year, or $5 million in interest per year. But the investment bank doesn't want their money tied up in all of this either, just like the original bank. So they do something interesting. They create a corporation, let's say it's called Big Mortgage Corp, and then they give that company the 1,000 loans. The company is now pretty profitable. It's worth $100 million and will earn $5 million in profit each year. Who wouldn't want to invest in that company? Well, that's exactly what the bank is thinking. The investment bank, Bank 2, will start selling shares of Big Mortgage Corp. These shares are mortgage-backed securities. So how does bank number 2 make money? Through the selling of these shares. Let's break down the math. The bank creates 1 million shares of Big Mortgage Corp to sell to investors like hedge funds, other banks, individual retirement accounts, etc. Each one of those shares is entitled to 1/1,000,000th of the company's profits. Over the life of the loans, they will pay back their initial loan amount, so each $100,000 mortgage. Times 1,000, they pay back the $100 million principal bank number 2 paid. Then they will also pay 5% interest every year that they have the loan, so the $5 million per year. So in theory, each investor in one of the shares of Big Mortgage Corp will get back $100 from the principal amount, 100 million divided by 1 million shares, and also get 5% interest each year, or $5 per year. That number is from $5 million in interest per year divided by 1 million shares. The bank then decides to sell each share for $105. Investors would be interested because over the life of the ownership of this share, they'd get back $100 plus 30 years of $5 per year, or $150 in interest. That totals $250 in value for paying just $105 initially. If Bank 2 sells all 1 million shares, they could make 1 million times $105 per share, or $105 million. Since they just bought the shares from the neighborhood bank for $100 million, they just made a cool $5 million just by giving a company they created the mortgages and selling shares in that company. Not only that, but they also got back their initial $100 million, and they can just do this all over again. So now the neighborhood bank has made monies on fees, the investment bank has made money by selling mortgage-backed securities or shares in Big Mortgage Corp, and the investors will make money over time through interest paid out by Big Mortgage Corp. All of this is great. Everyone makes money, and homebuyers are able to buy houses and access debt fairly easily. This is what mortgage-backed securities are, and it's their purpose as well. In actuality, though, some of these mortgages will default. People won't be able to pay, and some people will sell their home and pay off their mortgage before the full term. When this happens, the return on the mortgage-backed security goes down. But investors in mortgage-backed securities account for this through complicated models that they develop to determine the actual interest rates that they will make from their investment. Generally, they assume anywhere from 20% to 10% of all of the loans will either default or not be held to term. Here's how 2008 happened, though, oversimplified, of course. investment banks were running out of conforming mortgages to lump into these companies. Since they still wanted to turn a profit and make money through the selling of mortgage-backed securities, they decided they needed to loosen their guidelines for what makes a good mortgage. They did. Nearly anyone could get a loan by just saying they made any amount of money. It didn't matter. Banks wanted more loans to sell. These loans were terrible, though. Why would someone want to invest in a Walmart cashier's $1 million home loan? Surely they're not going to pay that. The big banks knew that, but they also knew that there was safety in numbers. The original mortgage-backed securities, the ones based on conforming loans, are safe because even if 20% of people default on their loans, investors will still get a good return. Not everyone will default. The investment banks thought, or at least publicly said, that if they group a bunch of these terrible new loans together, there's still safety in numbers. While one loan on its own might be at a high risk of default, if you put 1,000 of them together, there's no way they're all going to default. Ultimately, while each loan on their own might be a pretty terrible investment, if you lump them all together, not everyone's going to default, and you, in turn, can earn pretty high interest rates at the forefront. Since the loans were risky to begin with, the banks could charge insane rates to make them more attractive to investors. Lump all these loans together into mortgage-backed securities with high return, and investors wanted to eat them up. You're probably thinking, well, if that's true, why would the investors in those companies selling mortgage-backed securities want to buy them if they knew the loans in those companies were so terrible? Couldn't they just look at the loans in Big Mortgage Corp's balance sheet and see that they were terrible? Long story short, yes, but no one was doing that because the agencies responsible for rating the mortgage-backed securities, the ratings agencies, on how good or bad they were all rating them as AAA, meaning the highest of value. Investors took these rating agencies, which were supposed to be independent agencies, and bought up all of the shares of the mortgage-backed securities. The problem was the investment banks were in the pockets of these rating agencies. They needed the agencies to rate their mortgage-backed securities well so that they could sell them to investors. And agencies needed the banks to pay them so that they could make money. The banks refused to pay them if they didn't rate their mortgage-backed securities AAA, knowing full well that the loans that made up these AAA-rated mortgage-backed securities were all terrible. Long story short, investors like banks and hedge funds bought these mortgage-backed securities, thinking it's a pretty safe bet. Insane numbers of borrowers defaulted and investments became worthless, and the investors lost their money. All that said, there are a few other complexities and pieces of the puzzle here too. Let's take a look at collateralized debt obligations, or CDOs, and also take a look at something called a credit default swap, which will come up later. CDOs are types of mortgage-backed securities. In the example we posed before, mortgage-backed securities are simple shares of a company where every share gets the same amount back. CDOs are still shares of that company, but they have different levels of how much you get back, called tranches. Let's say the investment bank wants to split Big Mortgage Corp into 3 tranches: equity, mezzanine, and senior. These are the actual names used in the industry in this instance. Each tranche or level holds a hand-picked number of shares from Big Mortgage Corp. Equity is the lowest level, highest risk, but highest return. They hold the shares of the riskiest mortgages. If borrowers default, holders of equity-level CDOs are the first to feel the pain. However, if borrowers do end up paying up, the equity tranche gets back the most money. For example, rather than 5%, let's say they get back 7.5% on their investment. If you want to take the risk, it could pay off a lot better than other investments. The next level is mezzanine. These are the middle-of-the-road CDOs, moderate risk and moderate rates of return. Let's say they'll get back 5% of their investment. The safest level is the senior tranche. They hold very little risk but get a lower return. If a ton of borrowers default, Big Mortgage Corp is going to underpay the equity and mezzanine tranches to make sure the senior tranche gets their money. However, the senior tranche, let's say, only earns a 3.13% interest rate. CDOs are just mortgage-backed securities that have different levels of risk and different rates of return. Now, let's take a look at the actual math. For the original $100 million in loans, let's say we sold $40 million to the senior CDO, $30 million in the mezzanine, and another $30 million in the equity tranche. For simplicity here, we're going to ignore the need for the investment bank to make a profit on selling these stocks, and we're just going to look at that initial sale. For example, if we sold 400,000 shares of the senior for $100 each, that $40 million, each paying out a 3.13% interest rate each year, or $3.13 per share each year. We sold $300,000 of the mezzanine tranche for $100 each paying out 5% interest each year, or $5. And finally, we sold $300,000 of the equity tranche, or $100 each, returning 7.5% each year, or $7.50. The loans as a whole, meaning all the money that Big Mortgage Corp will bring in each year, is $5 million, assuming that no one defaults. If it goes perfectly, the senior tranche gets $1.25 million to split, their full $3.13 per share. The mezzanine gets $1.5 million to split, and equity gets $2.25 million to split, each tranche getting what they expected to make that year. However, let's say 20% of people default, and from now on, Big Mortgage Corp can only bring in about 80% of the original $5 million in interest each year, or $4 million per year. In this case, the senior tranche, which is the safest level, is still going to get its $1.25 million, and the mezzanine is going to get its full $1.5 million. But equity, well, they're the losers here. Equity shares get back only $1.25 million, what's left over, and that equates to $4.16 per share. They just saw their return go from 7.5% to 4.16% for the rest of the life of the share. All of a sudden, their share is worth less than the mezzanine share. Like I said, high risk, but if the economy is good and borrowers pay their mortgages, then the equity tranche can yield high rates of return. In 2008, however, where mortgages were being given out to terrible borrowers, let's say something like 80% of all the mortgages in Big Mortgage Corp defaulted because all of the loans inside were just terrible. That means that now there will only be 20% of the original $5 million in payments, or $1 million per year. The senior tranche would get the full $1 million in payments, meaning only $2.50 per share. In this case, even the safest tranche, the senior level, had their respective return cut from 3.13% to 2.5% for the foreseeable future. For the other tranches, well, their shares just basically dropped to nothing. That gives you a basic understanding of CDOs. They're just a way of assigning levels of risk to mortgage-backed securities. Now, on to the big kicker: credit default swaps. Credit default swaps are essentially just insurance on a security, meaning on a share. Equity tranche buyers might buy these assets in case their shares become worthless. They would be able to get some money back, so their losses aren't as bad, if anything, in the long term. In essence, this insurance shorts the market, or only pays out if the mortgage-backed securities they insure fail. It's used to protect mortgage-backed security buyers from high risk. The payout would increase based on the tranche level, but it would also cost more upfront. For example, equity tranches are high risk, which would make the credit default swap for this level pretty expensive, and the swap itself would only pay out relatively a little, basically just enough to cover the losses and lessen the blow. If we go to the senior tranche, credit default swaps would be cheap. Since credit default swaps are bets that the market will fail or the underlying security will lose value, that's pretty unlikely for the senior tranche, so they don't have to be that expensive. That said, it also means they have a very high rate of return or payout when this does happen. After all, why would investors buy the credit default swap if they didn't pay out a ton, since for the senior tranche they were unlikely to pay out at all? Basically, credit default swaps are just insurance on a stock just like insurance on a car. In 2008, though, this market got interesting. You don't have to own the underlying security or stock to purchase the credit default swap on it. Banks in 2008 were willing to sell credit default swaps on senior tranche CDOs, or just CDOs in general, since it was assumed that there was a crazy tiny chance that these CDOs, or mortgage-backed securities, would pay out. To the banks, it was basically free money, selling something that would never cost them anything, or so they thought. No one, in theory, would want to buy that, though, either. Senior tranches and high-level rated mortgage-backed securities don't lose money, so buying a credit default swap for these assets would be like throwing away money. Or, in other words, it would be like shorting the entire mortgage market. Buying credit default swaps for senior tranches or AAA-rated mortgage-backed securities is like betting even the best of the mortgage market is going to default, meaning that the rest of the mortgage market would default and collapse as well. In 2008, a few people dug into the mortgage-backed security market. They saw that credit agencies were misvaluing the assets in these securities. They saw that even senior tranches were crap, and they bought a ton of credit default swaps. This is like realizing your neighbor is a terrible driver and buying insurance on his car so that when he crashes, you get paid. Banks were happy to oblige because they themselves didn't know how bad the CDO securities were. They themselves didn't even look at what was making up their mortgage-backed securities that they were selling. When the market did collapse, the people who shorted the market by buying credit default swaps got a massive payday, like 500% return. So if they bought the credit default swap for $100, they'd instantly get back $500 when the market collapsed. If you want to see this in action, watch the movie The Big Short. And there you have it. There are some of the key variables in the mortgage market, some of the basic functions, and a little description on the 2008 mortgage market collapse. The actual functions of these markets have thousands of other variables that play into them, and for the most part, it's all technical jargon, and hopefully we were able to weed through some of that in this video, even if it was fairly lengthy. Ending on a positive note, let's actually look back at one of the worst times in American financial history. The Great Depression. The Great Depression sent millions into poverty, resulted in breadlines, bank runs, and otherwise the collapse of the global economy. It's almost been 100 years since this catastrophic event, so what caused it? Well, economists can't really agree, and it could happen again. The Great Depression was the most severe and longest economic downturn in modern history. Lasting from 1929 to 1939, the Depression wasn't just a downturn for the United States, it permeated throughout the entire world's economy. It caused massive unemployment, spiking to 25%, incredible declines in prices through deflation, bank runs, and high poverty and homelessness. While it was a global depression, during the Great Depression, the US experienced its effects worse than any other country. US GDP fell by 30% and industrial production fell by nearly 50%. To put this in perspective to something most viewers of this video are likely aware of, the recession of 2007 to 2009 only had a GDP decline of 4.3% and unemployment only rose to less than 10%. Based on these figures, the Great Depression was a GDP decline of 6x of the Great Recession of 07 to 09 and an unemployment increase of 1.5x. The Great Depression was, well, a Great Depression, except that it wasn't very great. It was more depression. But, well, you get the point. So what caused this massive event? Economists haven't really come to a consensus. Generally speaking, though, scholars agree on 4 main causes: the stock market, banking panics, the Federal Reserve, and the gold standard. First, the stock market in years prior had risen to never-before-seen levels and had become financed heavily on debt, known as margin. People took out debt to buy stocks purely because they thought the market would always go up. What this meant is that once prices started to fall a little in 1929, shares on margin started getting liquidated, sold to satisfy the debt, and so on, leading to total stock market collapse. In a 2-month period in 1929, stocks had fallen 33%. Confidence in the market was gone, and with it went consumer spending and any other investment opportunity. To follow this, in the early 1930s, there were several banking panics and continuing contractions in GDP and production. These banking panics consisted of customers worried that the banks didn't actually have the cash to back up people's deposits, making them worried that the money they thought they had wasn't actually there. By 1933, this uncertainty around banking meant that 20% of all banks in existence just 3 years prior had already failed. It was so bad that in the US, FDR actually shut down all banks for 4 days so they could prove that they were solvent or had enough money to the US government. Again, these failures tanked consumer confidence, and no bank was willing to lend money to investors. At this time, the Federal Reserve was also raising interest rates, making borrowing money more expensive. They were doing this to maintain the gold standard, the standard that meant that every US dollar had to be backed by gold held in US reserves. As the interest rates reduced the supply of money, again, people stopped spending. The gold standard caused foreign trade imbalances too, causing a back-and-forth cycle of foreign banks raising interest rates, causing greater unemployment, causing lesser output, and so on. It was a death spiral. While experts don't really agree on the exact cause of the Great Depression other than sort of these 4 general ideas, experts also don't agree on how we managed to recover from the Great Depression. Countries like England abandoned the gold standard in 1931, giving them a fairly quick recovery in comparison to other countries. The US also devalued its currency in 1933, but again, we didn't exit until 1939. Legislation like the New Deal in the US and increased defense spending for World War II and social programs played a huge role in increasing consumer spending and ultimately probably pulling the world out of the largest economic crash in history. So, what did cause the Great Depression? Unfortunately, it was fairly standard events. Events that could happen again even in modern economies. Since the Great Depression wasn't set off by some great event, it still stands as an ominous bit of history, constantly making investors and economists wonder whether history will ever repeat.